Hey guys, Toby Mathis here with Infinity Investing, and today we're going to talk about when you should buy or sell a stock. So let's dive right on in. So, whenever we're looking at stocks in the stock markets, you're going to hear this thing called charting, you're going to hear candlesticks and all this stuff. Here's what I can tell you absolutely, certainly, and with a ton of backup studies is that if you think you're going to time the market, it ain't going to happen. They've done huge studies, and there's lots of papers on this. If you are somebody who thinks you're going to take advantage of the daily swings of the market, you have about a 5% chance of success long term. They did a 15-year study, and it was actually worse than that. In the United States, they did a study, it was about 5% actually made money. The vast majority of people who try to time the market on a daily basis lose their shirt and absolutely lose. And it's not a small amount either, it's a significant amount that they tend to lose. So that's number one. Number two, if we're going to dive into this, the studies show that the buying consistently over time outperforms any other strategies for acquiring. And when I say buying in over time, they call it dollar cost averaging or whatever. Once you pick a good company and you start acquiring it, don't sit there and worry about doing a complete and accurate charting of that company. Just continue to acquire because nobody has a crystal ball. Nobody knows whether it's going up, down, or sideways. What we can do is use general rules. So we use 7 criteria when we're buying companies to say, is this the appropriate time? And one of those things we're looking at is it in a downward trend? And this is very general. We are going to buy companies that are either channeling or on upward trends. And that's going to keep you from buying, they call it catching a falling knife. It's going to keep you from catching the fallen knife. And that is channeling is just going, it's just staying in a pattern. It's not really going up or down. Or you're buying a company that is starting to trend up. You do not want to buy the company that's constantly making lower lows and lower highs. You want to wait for that one to either channel or to start back up. You also tend to want to buy companies that are closer to their lows than their highs. It's very, very instinctual to want to chase after companies that have had a run up. And you hear about them in the press and, oh, this is the next greatest thing. More often than not, you're going to be disappointed. It doesn't mean every time. There's the Teslas of the world that are defying logic and some of the Amazons of the world. But that's the exception to the rule, and you can't base your strategy on it. What we know is that if you consistently buy good companies over time, you will have success. If you buy and you try to time growth stocks, you will not. Studies after studies show that statistically over time, it's that tried and true buying over time on companies that are good companies that have maybe had a pullback, and you're like, this is a great deal. So one of the things we like around here is when the market crashes a little bit, like during the pandemic. If you'd been listening to me when the pandemic hit and we saw this big pullback in the stock market, I came on with Eric Dodds and we did a huge deep dive into the statistical chances of that market staying down over a 6-month period. And it was a 99.9% certainty that the market was going to come back in that 6-month period based off of all the black swan events, whether it be pandemics, whether it be terrorist attacks, whether it be depressions, whether it be HIV, whether it be any number of things, whether it's SARS or you name it, any scare, how quickly the market recovered. Generally speaking, there was only one time, I think it was the AIDS epidemic, where the market had not recovered fully and actually started going up after 6 months. And even in the AIDS, it was less than 1% off of its starting point. So we looked at it, we said, this is the great time to go out there and buy really good companies that are on sale. It doesn't mean you go buy all the, whatever the soup du jour is. We call it kind of the, whatever they're talking about on the internet or on cable news, those crazy people that jump around and try to get you to do stuff. It's about acquiring and holding. And so that leads us to the second period or the second concept, which is when should I sell? And here's my personal view is when you buy a company, buy a really good company, your holding period is forever. Now, if the company is giving you the heebie-jeebies or it's not meeting the expectation that you have, like it starts to have bad news. So like GE was one of those where it had been a high flyer for a long time, consistently paying out dividends. Then started having some trouble and it cut its dividends. I might dump it at that point because it's not paying me anything out. But I don't want to sit there and try to time and buy it back and that side of thing. Either it's going to be part of my portfolio or it's not. And I'm looking at it saying, it's kind of like they call it a brick drop method. It's like knowing what I know now, would I hold this investment? And if I wouldn't, then I drop it, just let it go. And I don't care, right? Just get rid of it. So if you hit that point with a company, do it, but don't do it because you're sitting there trying to time it and you think you're going to buy it back. Do it because you no longer want that as part of your portfolio. And generally speaking, it's because something really changed with that company. Maybe you don't like their politics. Maybe you don't like their board. Maybe they're cutting their dividend. And as a shareholder, you're like, you know what? No, I just want to get out. And the company may be way up. They may be saying, yes, we're retaining more money so we can do this. Or they might be doing more buybacks. Who knows? But if for whatever reason you say this isn't fitting what I like as it for companies in my portfolio, dump it at that time. But that's it. I'm not a big seller. Our holding period is infinity. The reason we call it infinity investing is because it's about where you're going to be in 200-300 years. It's not about making money right now, today, $1 million. I want to make $1 million right now. No, we are about making money consistently over a long period of time. And it might be that you're sitting there for 15, 20 years. And, if you're doing what we do, we rent out the stock, you're looking at the option market. Yes, you're looking at that. But wait until you look at how much money you've made over that 10-year stretch. It usually freaks people out because you should have gotten paid back way more than your original investment. You should now be gravy. And then compare it to your previous investing and things like, start comparing and say, oh my gosh, I'm either not making very much and I'm working my katush off, or I'm working very little and I'm making a lot more. But here I thought I was so smart, and here I feel like I'm lazy. I'm not doing enough. Good. That's how you know you're doing it right. It's when you sit there and say, I could be doing more. No, sit back and let these companies do what they're doing. In terms of everybody, I think that could relate is in the kitchen. You get a new recipe and you're trying to make something versus putting something in a crock pot and letting it cook. I was literally just talking to somebody whose wife is a fantastic cook, and she was just talking about what she does. A lot of vegetables, here's some onions and some peppers and cilantro, a good cut of meat, put it in a Dutch oven, one of those little things, and heating it up, and everybody loves her cooking. She's like, I really don't do much. I just let it cook over a long period of time, and everybody thinks, greatest chef ever, right? That's the stock market. You're doing it right when you're looking around going, what should I be doing? Right? When you have your portfolio and it's doing what it should be doing, which is producing income, you go in there, you're selling your options periodically, but otherwise you're letting these things grow. That's when you're doing it right.